Welcome to episode 47 of Contrarian Korner. I'm Ben Kellerin. Today we have a very special guest coming on to talk with us about the recent market sell-off. Everyone freaking out about tariffs, thinking the sky is falling, all the different reactions to what's going on. I've never seen as many people tweeting about the futures market opening up on Sunday night, and there seems to be extreme fear in the Wall Street bubble. But I'm really excited to have the guest on today to talk about all these different things. And I think we'll be getting into a bunch of different topics that will be interesting, especially given what's happened last week. So Mel Mattison, thanks for coming on.
Happy to be here, Ben, and it definitely is interesting. We were talking before we came on. It's exciting. It's interesting. It's one of those periods you don't see all that often, but you do tend to see them every 5-6 years. Something kind of major rocking the markets. The CNBC Markets in Turmoil episodes start coming out, and we're definitely in one of those periods. So fascinating, and happy to get into the conversation today.
Yeah, no, I appreciate taking the time to come on. I think if we could start by talking about your big picture view. I know it's a pretty broad question. I think it's a good place to start as far as what's going on with equities, what's going on with bonds, and tariffs and deficits, and how all this stuff is kind of interrelated. I think that'd be a good place to start.
Yeah. So, I mean, big picture, and I think it's kind of a good name, Kontrarian Korner, because I'm a bit of a contrarian. So in December, January timeframe, I was basically forecasting a 10 to 30% correction in the markets in the first half of this year, recommending, gold, T-bills, puts, reducing equity exposure. And that was at a time when I think pretty much consensus was all the big strategists coming out, 7,000 S&P, and we're going to have deregulation and all this. And the thought process behind it was that I couldn't believe this. It didn't make any sense to me. But market participants were tending to buy in that Trump was going to be able to do everything he said he was going to do immediately, that he was going to reduce deficits with Doge. He was going to bring down inflation. He was going to bring back manufacturing. He was going to explode GDP growth with tax cuts. He was going to be able to do all of these things that in many ways act in certain respects at cross purposes, and that for a number of them take time to play out, and that eventually this tension and this kind of rational inconsistency in these Trump promises, I'd call them. And then I say I am a Trump supporter, but I'm not here to just rag on Trump. What I'm ragging on is just the market's belief that everything was going to be hunky dory. And we also had extremely high valuations, right? We had companies like Palantir, we had the Mag 7, and yet
Costco at 60 times earnings.
Exactly. And underneath the surface, we had the average stock kind of rolling over. I think the median S&P stock peaked in October, before the election even happened. If you look at, the broad Russell 3000, the median stock hit their high in October. So this process and a lot of what we're seeing now, I believe, is totally triggered by tariffs. But I think, I don't know exactly what the percentage is, but probably at least half of the decline, if not more of it, is the market saying, hey, wait a minute, we got really over our skis. I mean, we went up like 20-some% in 2023, another 20-some% 2024, pretty much on a straight staircase up. And, markets needed to come in regardless of whether or not there was going to be this tariff mayhem. Then you add and lump on the tariff mayhem on top of it. And now you're just seeing, people that were basically totally get caught off sides, thinking it's going to be an IPO boom and an M&A boom. And all of these things are just going to be, skyrocketing the S&P. And so they're caught off sides. And I think at this point, we're not there yet, but now we're going to get to a point where market participants are going to start thinking that basically we're heading for a financial calamity a la 07, 08, or even a la 1920s, 1930s, depression type stuff. And My base case is that's not what's happening here, that we're having a market pullback because of overpriced valuations, that we are in the heart of massive trade negotiations, which are going to have ramifications and which I believe can likely pull the markets down further. Maybe that's a 4,100 level on the S&P, probably bear case like a 3,500 level on S&P. But that at the end of the day, the structural situation, and we can get more into what I mean by structural situation, the structural situation of the U.S. economy now is going to preclude this from spiraling into a true like blow up at this point in time, at least, of like the global sovereign debt market that's literally going to crash the market 75%, and we're going into like a Great Depression era. And I think, probably the market will bottom when you're going to start hearing people like predicting that's the case. And people are already getting a little worried. They're saying, oh, well, the 10-year yields are not dropping today, even though the market is down. But if you look at like a weekly long-term chart of the 10-year, we hit kind of like a bottom trend line with yields, and to have a little bit of a bounce is not surprising. And what's also very different about the market right now is normally in these moments, you have the Federal Reserve coming out and slashing interest rates. And so if you want yield in a government bond, you go to a 5 or a 10-year bond, but you can actually get more yield in a 3-month T-bill. So if you're in a flight to safety market, why would you fly to safety in the 10-year when you can get a better yield in the 3-month? And so we're not seeing certain typical dynamics you might see. So all this stuff is playing out. But I think my main point is that there's a structural situation to the U.S. economy that's going to preclude this from being a super long, drawn out, deep crash. And, that's a little bit of an explanation of what that structural situation is. But I'll pause there.
Yeah, no, I think that's a good overview of where things stand. One of the two guys I've been talking to, just messaging back and forth, he kind of pointed out that if you like basically have equities get completely hammered, then your capital gains evaporate, deficits get worse, and you kind of have all those other issues, even if they are trying to cut spending. And like a lot of people are freaking out, but I think the general view I have is that they're going to try and thread the needle of not crashing equities, but also having the chance to refinance most of the debt that's rolling over at a reasonable rate, and kind of doing that in the next window of 6 months, 12 months, whatever it is. And I think that's generally what they're shooting for. Whether they can do it is maybe another question, but I guess what's your view on that as far as like what happens to deficits and all these other things if you do get like a serious, prolonged, kind of drawn out bear market?
Yeah, I mean, I think there's two, big important points in there. One is what I would call like the rollover window that's coming up for both government debt as well as consumers as well as commercial debt, right? So you've got mortgages in a lot of countries that aren't 30-year fixed, that have like 5-year fixed rates, and then they go variable, and you're seeing central banks around the world cutting rates. You've got corporations that took out a lot of 5-year debt in 2020. That's going to need to be rolled over. Of course, you've got the U.S. government, which has an exploding balance sheet and high interest costs. So there is like a need, if you will, in the system for lower interest rates, and that's very important. And then the other point is, okay, so if we, and this is why I don't buy into we're going to create a massive like recession to bring down interest rates because we need lower rates, because like you said, there's so many forces, and this is part of that structural forces of the economy that actually don't give you that outcome. Like you said, okay, so number one, you lose a lot of your tax receipts if you have like a prolonged downturn in the stock market. Everybody is selling stocks, some of it at losses. They're generating capital losses, even to go against, some of their positions that they're selling that have profits. So you're pulling down the tax receipts from capital gains. You also have, especially in certain states like California, a lot of the income that people get is stock-based comp, right? So, they get issued a group of shares at a certain price. And if they go into the market at the end of the year to vest those options or sell those shares, and they're at a loss or whatever, then there's no gain on those, right? So you're losing tax revenue that way. Also, if you have the recession, right, you lose jobs. So now you're losing income tax revenue from the average worker. You're also then jacking up the number of people that are going to go on Obamacare, or that are going to be getting, unemployment or income security type benefits, which a lot of times are paid out on the state level, but they're subsidized by the federal level. And so what you wind up doing is you wind up collapsing tax receipts and then having a bunch of expenditures for these social programs, and you blow out the deficit and you get the exact opposite result. Now, is Trump a super nuanced thinker in these areas? I don't know, but I do know that Scott Bessent is. And I know that, Trump has some competing voices in his ear. He has like a Peter Navarro on the one hand, who has had a thing against China for decades. It's almost like a personal fetish that the guy has. And then on the other hand, you've got, someone who's a more calm, rational market thinker like Scott Bessent. And you also have a lot of politicians. You have people in, let's say, GOP districts that didn't vote for Trump in 2020, that are basically moderate. They're not really MAGA. They're kind of well-off Republicans. They went for Trump, but they also are relatively well-off, and they have 401ks. And, you get 5 congressmen to say, from these moderate districts, to say, look, we're not going to support anything that Trump does if he doesn't stop the bleeding here. And there goes his entire agenda. Could go his tax cuts, or could go. I mean, there's so many possible things that are at play right now that's why you're getting, the VIX at overnight. I think it actually hit 60. So all these things are up in the air, and they're causing a lot of uncertainty. And it's a bit of a fog of war type situation. And there's a lot of selling first, asking questions later. And there's margin calls. There's all this stuff that's going on right now. But, we saw this morning the somewhat erroneous news story that Trump was considering suspending tariffs for 90 days, except for China. The market shot up 8% in 30 minutes. It basically did an average year's gains in 25 minutes. And when you have a market decline like this, when you have like 5% down days in a row, I mean, there's nothing to say that you can't have, a lot of times it goes up slower than it goes down, that sometime in June or July, we don't have 3 or 4 weeks in a row where it goes up 5% a week, and we have a 20% up month. And, why would this happen? I think it's because at a certain point, whether it's European policymakers, whether it's the Federal Reserve, whether it's Donald Trump, they're all going to realize that if all 3 of them kind of continue on the path they're on, Powell saying, I'm not going to do anything at the Fed, I'm data dependent, Trump saying we're not going to do any negotiations on tariffs, China or Europe, threatening to increase tariffs. Eventually, they're going to understand this is mutual assured economic destruction. And I think even at the darkest days of the Cold War in the 1960s, yes, there was real fear that we were heading into World War III, and that the entire human civilization was going to be blown up by an atomic barrage. But it didn't happen, because at the end of the day, cooler heads did prevail. And I don't know the exact way this is going to resolve itself, but I feel like at the end of the day, cooler heads will prevail in some sort of solution that maybe nobody's even thought of right now, that's going to somehow give Trump a little bit of a win for some of the things he's pushing for. It's going to be something that China and Europe and India can live with. And it's not going to completely crash the system in like a systemic way that is unrecoverable. And in that process, what might happen is we might get lower interest rates. We might get the Fed doing 4 or 5 cuts this year, which nobody thought was going to happen a couple months ago. We might wind up getting a bunch of fiscal stimulus, like, plans put in place, like, okay, the US does need to make more stuff here, especially stuff that is either directly related to national security or a derivative of national security. And by a derivative, I basically mean like in World War II, we were able to go into car plants and make them Jeep plants. We were able to go into watch factories and have them making, altimeters and different gauges for airplanes. So we need we can't have no manufacturing here on a national security basis. But there's two ways to get that to happen. I mean, one of it is like 100% tariff on the world. Maybe that does it. I don't know. There's also like a fiscally stimulative way to make that happen to incentivize things. I mean, I could see one-off deals being done with companies where it's like, okay, we're going to exempt you from tariffs for 2 years if during that time period you actually break ground and start building some plants here. And if you don't break ground and build those plants here and hire American workers, and in 2 years those tariffs are going to go back on. Or there's just so many different kind of ways that this could work itself out. But I think in this initial phase, this is like the pre-fight weigh-in phase where everybody is just spitting vitriol at each other, because from a game theory perspective, that's what it makes sense to do. It doesn't make sense for China to respond to what Trump just did and say, okay, Trump, we give in. We're gonna lower our tariffs. Like, they have to come out and put something on the board that then when the real negotiations start, they can pull away. And I think Trump put up these huge numbers so that when the negotiations start, in negotiation studies, that's called an anchor point. He's put these huge anchor points so that he can start pulling those away. And I think that process is ugly. It's uncertain. It's unnerving. It's scary. But I do think that it's going to get some sort of a resolution, maybe not a perfect resolution, but it's going to stem the bleeding. I think probably, and this is, just a spitball guess. I mean, maybe it's sometime around the Fed meeting in May when we bottom at maybe that 3,500 or 4,100 level, or, who knows what it's going to be. But I don't think it's going to be drawn off over 6 months, because then you're going to do damage that you can't fix. And I think that the cooler heads are going to start to realize that in the coming days and weeks, and that something gets resolved somewhere at the end of April, May timeframe, where there seems to be a light at the end of the tunnel. And then the market can, now that it's pulled back to reasonable valuations, can start, climbing that wall of worry once again. And we could wind up actually getting the new highs by the end of the year, as crazy as that sounds.
Yeah, interesting. The one thing I'll maybe throw in too, I think with the tariffs, like people said, it's not logical how they did it, and the formula is all jacked up. Doesn't make sense. But I think if you view it as, hey, this is more of a negotiation tool, like a starting point for where we want to take things, I think part of the reason that they were, maybe some people would say, excessive is that basically puts a sense of urgency in these other countries to come to the table and do it quickly instead of dragging their feet. So I think from what I've seen, it sounds like there's a lot of countries that are working to come to some sort of resolution and do it pretty quickly. I wouldn't be surprised if it's already kind of channels being made and whatnot. But as far as equities and whatnot, you kind of said 4,100, somewhere in there. Like, you think another 15 to 20% is in the cards from here?
Well, I mean, if you look at what the close was today, it was around 4,800. So that's only 700 points on 4,800. That's I don't know what that is percentage wise in the top of my head, 15%. I don't know what that is, like a 30% drawdown from the highs. The high was 61.47 in the S&P. So that would be basically a 2,000 point drop off of 6,000. That'd be a 33%, pullback. So like I said, these levels are, possibilities. Some news could come out next week and, 4,100, we don't hit it. But I think one thing, when you look at drawdowns a lot of the times, is when they happen very fast, they have the potential to recover relatively fast. If you look at COVID, the NASDAQ was down like 40, 50%. By the end of the year, we were at, we were at the year highs, or it might have happened in January of 2021. Anyway, within 12 months, we were at new highs. If you look at 2008, 2007, like we hit the high in 2007 and we didn't bottom until 2009, and it took longer to get all that back. So in some sense, the fastness, the steepness of this drawdown, in some sense, is actually encouraging, because it means from a technical perspective, the rebound can be quicker. Now, I think if people have talked a lot about Trump saying, look, these are just negotiation tactics. I do think there's a negotiation aspect to it, but I also think there is, a real national security concern. There are real issues with the U.S. deficit and debts that we have, and that those things need to at least begin to be addressed. And I have said in the past that to truly kind of remake the global trade system in a way that's more sustainable and beneficial for the United States, my estimate was like we probably need a good 12-year period of certain policies being put in place to do it. This could be like a boot camp, starter move. And so Trump might not get all he wants, and people might say, well, he's not going to fix the $300 billion trade deficit with China next year if he makes this deal with them. And that might be true, but he might cut it from 300 billion to 225, and he might get certain commitments for certain sensitive industries to start manufacturing in the US again, that start putting us on that path. It took us decades to get into this situation. We're not going to get out of it in a year. And Trump, for all of his craziness, he does tend to be a pragmatic guy, and he's I don't think he's as ideological as people think, and that even though in his demeanor, like you could listen to him on the airplane yesterday, it seems like there's absolutely no chance that he wants to negotiate or settle, or like he's going for zero deficits with China, hell or high water. And it seems like that right now, and he could totally have a different tone in like 2 or 3 weeks, or maybe it takes 2 months with China, because I think China is the big one. China is the one with the big bullseye on it. I think it's easier to do a deal with India, which some negotiations have already begun. It's easier to do a deal with the EU. It's easier to do a deal with some of these countries that the US security apparatus does not see as a peer competitor to the United States from a geopolitical standpoint, which I think they do see China that way. And so I think, we could start to see ways that, maybe China tries to isolate things away from us and do trade pacts with South Korea or Japan, or try to do certain things. But we could also see ways that the US tries to isolate China and say, okay, we've got a great deal in place with India now. We've got a deal with Mexico and Canada, because they're our neighbors, and we've got, the EU. We created a grand deal that included additional NATO spending and, get some of those goals achieved. And like this stuff, it takes time. It's not going to happen next week. And that's why, I'm thinking more in May, which is a month away. The Fed meeting is exactly 1 month from the date we're recording this. So, I think let's see what happens over the next month. I think this could be the most volatile month we're going to have. And then things start to calm down, a month, 6 weeks from now. And we start doing a slow climb back up that could very quickly start to ratchet up. If other things occur that we haven't gotten into yet, which is another structural point to the economy that's very different this time around, is just with the closing of the border, we are still seeing an incredibly strong employment and labor market, and that I don't think the labor market is as soft or ready to crash as a lot of people think we're on the verge of. That we're heading into a recession, the labor market's going to crash, and we're going to, be in for, this prolonged downturn.
Yeah, I do think is interesting to watch the people talking about all these different things, because there's just a general broad sense of uncertainty. And like you're saying, if there are deals made or some resolution. And like you said, I do agree that China is kind of the target, and they're potentially trying to isolate them and make deals with other countries quickly. But as far as where you kind of see all that stuff heading, one other thing that I'll add is, since the US dollar is the global reserve currency, right, kind of have to run structural deficits. Like, what is the tug of war that's going on kind of those two things, with the structural deficits on one side versus, hey, like, there are some things we need to build here in the US just to have a functioning military, country, right, industrial economy, all those things.
Yeah, I mean, this is something I've talked a lot about in past appearances on shows, like, you know, the Triffin dilemma, going back to Bretton Woods. Like, the problem that you have with a single country being the reserve currency is that the world demands that currency, in this case dollars, and so you basically force the country that is the reserve status to run massive deficits to fund the world's liquidity needs for dollars. And so I think we do need to move away from that more towards a neutral asset, whether that's gold or maybe a little bit of Bitcoin, but predominantly gold probably, as part of the true monetary system, you know, in a more formal way, the way it has been for most of human history, where gold is this neutral reserve asset. And I mean, this gets into potential for a gold revaluation. This gets into, you know, movements away from this post 1971 system that we've been in, which, you know, it worked for a little while, but it worked when, you know, it began, because the United States debt to GDP was like 30% under Volcker, right? So Volcker was able to raise interest rates. The U.S. was able to, you know, issue tons of debt and run massive deficits for decades, because we started at such a low point. And we're back to a high point like we were after World War II. And the only way we got out of that really was with inflation and manipulation of interest rates, where the Fed artificially kept interest rates low and we inflated our ways out of it. And ultimately, I see that's still to come. And once the market starts to say, okay, we are going to need to inflate away the real value of this debt to some extent, and then we're going to work on putting in, you know, a different system that we phase in over a multi-year, if not multi-decade period, which is already happening. I mean, the amount of dollars that are on the balance sheets of central banks as reserve FX reserves has been declining. Is basically for 15 years. So this process, this multi-decade process of moving the dollar away as the neutral reserve asset, I think is in place. I think it's speeding up. It's going to continue. And ultimately, that's going to be bad for long-term bondholders. It's going to be bad for, it's going to be bad for purchasing power of the dollar. However, if the border is closed, if jobs remain strong, I think real wages, and every time Besant mentions like the middle class, he talks about increasing real wages. He always uses that word, real wages. And I think there's a bit more tolerance for inflation in the administration than people recognize. But I also think they want low interest rates. And so the issue right now, I mean, part of the problem with this is I think is Powell. And, you know, what Powell does, he's a bit of a wild card. We don't know, because he doesn't want to go out next year, you know, having restoked inflation and being too easy. But, you know, by this time next year, you know, Trump will be in a position to put in a new Federal Reserve chairman that's going to be able to work more, you know, within the administration's parameters of what they want to do. And at that point, I think, you know, you're going to get, you know, lower rates. You're going to get, I don't know if it's, you know, FHA guaranteeing second mortgages on homes, if it's kind of removing the supplementary leverage ratio requirements on banks of how many treasuries they can hold. You're going to get some sort of money printing type quantitative easing, yield curve control situation that I think is necessary to bridge the gap as we move through this transformation from the dollar as the basic reserve asset into something neutral, whether that's gold or Bitcoin or other holdings. And I think that process is going to take time. But I think if you try to do all of this at once, you will crash the system. Like this has to be done over a multi-year period. And I think this is like an opening salvo, and that the forces are going to pull back from the breach a little bit when they realize, like, hey, if we keep pushing down this track, we are going to create Great Depression 2.0. And I mean, some people are worried that they're not going to have that foresight and that they're not going to do it. And I think it's naive to say that there's not potential for that. There's always that potential of huge, massive, prolonged policy mistakes. I think we're seeing some policy mistakes, but they're fixable. And so my bet is that cooler heads will prevail. Things will be, pulled back a little bit, and that a longer term strategy that's actually sustainable to correct some of these issues, like the trade deficits and the money printing and all of that, gets put into place. But in the meantime, you get you're going to get lower interest rates, and you're going to get fiscal stimulus, especially from non-US countries.
Yeah, I do think, to your point on inflation, I have kind of wondered, depending on how all this tariff stuff shakes out, if that points to stagflation versus inflation, or how that kind of what direction that leads. But my general view is that since 2020, like, we're in a regime shift, cycle shift, whatever you want to call it, and the general trend, I think, is more inflationary times and kind of a inflationary cycle in general. But how does that feed into your view on commodities, whether it's gold, oil, kind of general commodities complex, if you have any views on it broadly? But I'd be curious to hear your thoughts on where all that is headed.
What I mean, I think until this plays itself out, which I've said I don't think is a long time, let's call it 4 to 8 week period, it would be bearish on commodities in general. If you look at oil, trading down into the 50s, I think last night, once you get to those levels, all of a sudden, like, it's not profitable to do any, shale, like you start pulling supply away. So I think, like, there is like a structural bottom in the oil market that's probably around 60, but we could overshoot that and go down to 50 or even get into the 40s, sometime. And people are like, whoa, this is crazy. But here's the thing about oil is probably the most correlated commodity asset to inflation. And if you're Jerome Powell and you're the Fed and you're sitting there and you're saying, well, we need to be data dependent and we need to wait to see before we can move. But you're looking at $50 a barrel oil or $60 a barrel oil. Like, how can you say that inflation is coming? I mean, if you're looking at copper dropping 25%, if you're like the U.S., it's like 11% is imported goods of the economy. And if you think like JP Morgan raising a recession probability to 60%, like if you start, and then if you also agree that Federal Reserve, interest rate movements have long and variable lags, you can't wait until October to cut rates. You have to start cutting in May or June. You have to start making these moves. And so that's why I do think that the Fed's going to cut in May. I think they're going to look out at the economy, and we could be near the bottom of this whole thing around that time. The S&P could be at 4,000, 4,100, 3,500, and oil in the 50s. And they're going to say, look, we have to cut. I mean, like we can't, like the job markets, and they're going to worry about the job market. They're going to say, oh, the job market's going to fall out of bed, and you're going to get interest rate cuts. And then a few weeks later, then they're going to start on this interest rate cutting regime, and they're going to already kind of be down that path, and the markets are going to be low but bottoming, and then trade deals are going to start to get resolved. Maybe the tax cuts get passed, the debt ceiling gets raised. Maybe some of these fiscally stimulative programs start getting put into place, whether it's 100% depreciation on plants and manufacturing. And then the economy or the markets are going to have this 180 switch in mindset, just like they had a 180 switch in mindset between January 1st and today. They'll have another 180 switch in mindset where they're going to be like, okay, rates are a lot lower than they were at the beginning of the year. The Fed is cutting, and now we're getting tax cuts and we're getting fiscal stimulus. And these trade and tariff deals are starting to get resolved. They're not perfect. There are still tariffs being put into place that's going to cause some issues. But generally speaking, we're in a good place. Valuations are fair. They're at 16 times or 15 times earnings, and like people are going to want to buy. And so then the whole psychology, the whole mindset switches. Like we've seen it happen so many times. How many times do you watch and you think, oh my God, the sky is falling? Like in March of 2020. I remember people I worked with in finance saying, they just need to close the markets for a few days. This is like this is out of control. And literally I was buying, and I'm like, look, I don't know if I'm picking the bottom here. And I didn't pick the bottom. I think I started buying when like the NASDAQ was down like 20%, and it wound up going down like 40 or 50%. But I started buying, and then I bought some more, and then I bought some more. Eventually I did hit the bottom, and then I bought some more. And eventually, 12 months later, the NASDAQ was making new highs. So like we've seen this before in these really quick, sharp sell-offs. And this is not a slow, drawn out sell-off like we had in 2007, 2008, or like we had in 1999 and 2000, something that take months and months or years like it did like high was in 2007, the low was in 2009. That's a multi-year drawdown. I don't think that's what this is heading into. And so I don't think it's going to be a multi-year recovery period. I think if the drawdown from February and we hit a low, let's say in May, that's February, March, April, May, that's 4 months. I don't see why we can't get that back in 8 months, right? And so, if not sooner, depending on what happens. And so, my original call was a 10 to 30% drawdown this year, but a hard rally back to new highs by the end of the year, around 68, 7,000. Maybe that is a little bit optimistic right now. Maybe that's like a very bullish case scenario. But even if I was to pull that in a little bit, I still would think that 6,000 by the end of the year is easily doable. That's not to say that we can't drop 15% more from here. But I think that this idea that this is going to be a long, prolonged, like financial crash that is like a Great Depression, which I'm hearing some people start talking about, or like 2007 or 2008, I think that's not the situation, and I could be wrong. And this isn't, financial advice. I'm not recommending one thing or another. Each individual's investment position is unique. But if I had to say, I could come out here and say, well, it could go up, it could go down. We could, of course, everything I'm saying, everything I'm saying, like I could be like one of those guys. Yeah. I don't know if this happens, that happens. That. Of course I don't know. Of course I don't have a crystal ball. This is what my base case thinking is right now. In December and January, when I was calling for a 10 to 30% pullback and other people weren't seeing that at all, I was contrarian and I was proven out to be right. Right now I'm being contrarian. Will I be proven out to be right this time? Maybe, maybe not. But a 6,000 to 7,000 S&P on January 1st, 2026. Will that happen? I don't know, but that's my base case.
Yeah, I think a lot of people, like you're saying, everyone gets on one side of the boat, and then positioning just kind of by its nature sends things the other way. And so when you have sentiment as bombed out as it is right now, I think at least if you have a shopping list, it's a good time to be looking, whether that's broad S&P 500 or individual names. Is kind of right, like you said, up to individuals. But the other thing I do want to get into, because that's been something that I've been focused on for a while, is kind of the geopolitical situation, because I think that is a big question mark for how the next 6 months look like, as far as Middle East or Ukraine, and some of the things I've been seeing with like B2s moving to Diego Garcia, like extra carrier group in the Middle East, other material and personnel heading that way. And then the rhetoric out of Europe, it makes me a little bit nervous that they're going to make a big mistake as far as what they're going to do in Ukraine. So I'd be curious to hear what you have to say on that front, and if you have any worries about what might be coming as far as the geopolitical chessboard.
Yeah, I mean, I do think that probably the bigger concern for me would be the Middle East and just the push that sometimes the Israel lobby or Netanyahu, whatever you want to call it, can have in a Trump White House. He's obviously been very pro-Israel. The United States has a history of being pro-Israel, even when it's against its own interests. And I think it's a function of this very powerful, lobby in the United States that's very politically active, very heavy donor network, very relationship based with literally every single member of Congress, things like APAC and different things that they're able to kind of, move things in directions that probably the United States, if it didn't have that lobbying effort behind it, would not go. So what I would worry is that Netanyahu, starts convincing Trump that they need to make a move on Iran. And now, I mean, given all this economic turmoil and given that potential is out there, I mean, okay, if everything goes haywire and wrong, I mean, hell, we could get S&P 3000. I mean, easy. Like all this stuff could just completely, fall apart. But, you always have to have, an imaginative, open mind of what the potential is. And that's why you don't go 100% in on like a base case position. Like, it's like my base case might be we're going to rebound, but I'm not to 6,000, but I'm not sitting here today buying, I'm not going in there and saying, oh, I'm so convinced of this. I raised cash at the beginning of the year. I bought some puts. I've sold some of those puts. I have got treasuries. I've got gold. I've got cash. I have a couple, core equity positions that I'm in for the long term. I'm waiting to deploy that cash because I'm not 100% sure about any of this. But what I do think is, the Middle East conflict is a little bit more worrisome to me than the Ukraine conflict because it has the potential of drawing the U.S. and U.S. forces in a way that I don't think it could happen in Ukraine, where, maybe Ukraine doesn't get settled. Maybe it just continues in this weird stalemate and people continue to die needlessly, but it doesn't, escalate from a U.S. perspective. But if you look at, the Middle East, there's real potential there for escalation. I think Trump's inclination, his instincts are not to get into foreign wars. And my, fingers crossed hope is that even if Netanyahu pushes hard, like we need to do something, take out Iran, whatever it is, that again, that cooler heads will prevail. And I know I'm counting a lot on cooler heads, but cooler heads will prevail and some sort of a situation gets worked out with Iran that, basically takes their nuclear weapon off the table, because it's been openly stated policy of Israel and the United States. They're not going to allow Iran to have nuclear weapons, and they're going to go in there if Iran proves to have one. So I don't think it's in Iran's interest to do that. I think, if you look at, take away the hyperbole, take away the public pronouncements, and just give people a benefit of the doubt of having some sort of a rational mindset. I don't think it's rational for Iran to say, okay, we went live with our nuclear program. And then Trump, like nobody wants that to happen. That doesn't mean it can't happen, but nobody really wants that to happen. And I think just like nobody really wants us to go into another Great Depression, that a lot of this is posturing and a lot of it is showmanship. I mean, Trump is the greatest showman politician of our lifetimes. And I think he can be very convincing. And he wasn't convincing the markets a week ago. The markets were not convinced that he was serious about any of this. And now the markets are taking him seriously. And that doesn't necessarily mean that he's willing to drive the economy off the cliff, but it does mean he's going to continue to act like he's willing to drive the economy off the cliff because he's in the midst of these negotiations right now. And we don't know what's really going on behind that crazy head of his of it. There's a great line in the movie, like Patton. I don't know if you've ever seen that movie, but like Patton is getting ready to launch an offensive, and there's like a big snowstorm, and all his generals are saying we need to pull back and all this stuff. And he just yells and screams like, we will never retreat. We will never pull back. We will all die or be victorious. It's something like that. And one of his aides comes up to Patton and says, General, sometimes nobody can tell when you're being serious or not. And Patton's response is, it's not important that they know. It's only important that I know. And, it's not important in Trump's mind. It's not important that the world knows something, which could be the case. In the back of Trump's mind right now, he could be like, there's no way I'm letting this get too out of control, and I will pull back, and I will blink, and I'm going to do this. He might already have made up his mind that I'm not going to take us down this scenario. That you just don't know. And I think we could be in one of those moments where Trump is thinking to himself, it's not important whether the world knows if I'm seriously ready to drive us into a Great Depression or not. It's only important that I know. And so maybe even Besant doesn't know. Maybe even, Lutnick doesn't know. Maybe Navarro doesn't know. Maybe only person that knows is Trump, and maybe he's not even sure himself. But I think at the end of the day, he'll come to that conclusion. I don't want to be Herbert Hoover. And I think he'll come to that conclusion eventually. And I think as long as he does it within the next, month or two, there's time to put some of this toothpaste back in the tube. If he waits 6 months or 8 months, in my opinion, that's if he waits that long to make some changes and get some deals done, then we really are in trouble. But I don't think it's going to take that long.
Yeah, I think the one of the things too that I think will be fascinating to watch is how this all plays out in relation to Social Security, Medicare, Medicaid, other stuff. That if they're talking about spending cuts, then if they want to do it in a big way, that has to be on the table eventually. But I think we're maybe not there yet, at least politically. But to kind of take a detour a little bit, one of the things that's taken a backseat to the tariffs recently is the talk of the sovereign wealth fund. And that's one that has kind of piqued my interest, where I look at it and say, okay, if they are able to structure this halfway decently, then it could be something that is a big benefit to the country long term. And I think that's one of the things is it appears obvious to me they're not just worried about the next 6 to 12 months. They're actually trying to figure out, hey, how do we make this work over like 5-10 years, longer term period. And with the sovereign wealth fund, people say, oh, you can't have it if you're running deficits, all this and that. And you look at the assets that the federal government has, whether it's Alaskan oil or whatever it is, right? There's, I think, a lot of different things they could do with it. But I'd be curious to hear if you have any thoughts on what a sovereign wealth fund might look like.
Well, I mean, I think, there's kind of like two situations, right? Like we talked about. On the one hand, there are these big issues that I do think the administration is serious about addressing, not necessarily addressing and fixing overnight, even though they might be acting like that right now. And those are the trade deficit with China, the dependency on foreign manufacturing from a national security perspective, the fact that we couldn't produce artillery to supply to Ukraine and Israel, or different, like we couldn't keep up with the Russians. Like these are serious issues that need to be addressed. I think the long-term solutions to all this are, like you said, they're multi-year periods. That sovereign wealth fund, they said, we're going to get that set up within 12 months. One interesting thing about that 12-month period, and they said this in January, that's also around the start of the new year, which also is just a couple of months away from when they're going to be appointing a new Federal Reserve chair. And so I think there could be kind of two tracks going on, right? There could be like, this is the shot in the arm of kickstarting a movement to get people to understand, like, we're serious about fixing some of these structural issues. And we're going to make some headway and get some wins and make some progress on it. But then we're going to pull back a little bit from the edge. But that's the short-term starting point. And then longer term, this is where we're getting into the sovereign wealth fund. We're getting into ways to, I think, remove some of the need to finance the U.S. government with huge amounts of, interest-bearing United States treasuries, and figuring out a way, because I mean, we're not on the gold standard. There's no reason why the United States needs to be paying interest on the money that it creates. And I mean, it's really like a big charade, right? Like we print a bunch of money in a hard time, and the Federal Reserve buys the debt, and then we pay the interest to the Federal Reserve, and then the Federal Reserve literally sends the interest back to the Treasury. Like it's kind of like a for show type of a situation. And I think there's certain monetary levers that the federal government is trying to pull back into the Treasury Department. The Treasury historically has control over the currency. I think we haven't gotten into currencies that much, but I think currencies are a big part of this. And I think part of this trade negotiation solutions could be things that happen behind the scenes regarding currencies and the purchasing of U.S. debt, for example, that the public doesn't even become privy to. So maybe he does a deal with, South Korea, and, they don't talk about it, but there's a handshake deal like, okay, we're going to increase our U.S. Treasury buying a little bit, and we're going to, devalue the yuan a little bit. And, this is going to create a weaker dollar. It's going to lower rates, and do that with country after country after country, allowing the banks, taking off the supplementary reserve ratio requirements on treasuries, allowing the banks to absorb treasuries, stable coins, passing a stable coin bill, the Genius Act, which is going to try to get people, again, it's a sponge for short-term U.S. Treasury debt. So trying to create all of these places to kind of plug all of these holes that exists because the United States is supplying liquidity to the world because of the reserve dollar status, this Triffin dilemma thing, and Trump administrators saying behind the scenes, look, we can't afford these deficits at 5% rates. We need to find somewhere to put all these treasuries, or we're going to go bankrupt, and that's going to crash the whole economic system. And you need to help us figure out a way to do it, a la the Plaza Accords or some of these other things. So the one group who might not be willing to do a lot of this is China. But, Xi, he's not exactly in an invulnerable position. There are people in China who are not necessarily, happy with how things have worked out. And it is a very restrictive dictatorship, capital controls. So I think it's important to remember Xi is not omnipotent, and neither is Trump. As I said, Congress people can create challenges for him. The Supreme Court with, does the president really have the ability to pull these tariffs? Can lay challenges for him. The markets can lay challenges for him. And so all of these leaders, even though they're very bombastic and they seem, omnipotent and like there's nothing that can stop them, I think at the end of the day that there are real realities, economic structural realities that are going to keep some of the worst case scenarios from occurring.
Yeah. One of the things you're talking about there with the currencies, I guess before I let you go, I do have to ask about, because I kind of have a long-term secular view that the dollar is basically here to stay. I know people talk about dollar collapse and all this other stuff, but I look at Europe, especially as kind of the sucker at the card table, or odd man out as far as where things are headed. I think the EU is probably going to be cracking apart by 2030. So I'll kind of stick with that prediction I've written about a couple times. But as far as kind of big picture views on maybe some of the major currencies, I'd be curious to get your quick thoughts on those before we start to wrap it up here.
Yeah, I mean, I'm not a fan of the EU. I mean, I think it's kind of a flawed system, right? It's multiple countries with the same currency and monetary policy and different fiscal policies and different economic dynamics. It's suboptimal, to say the least. And so, I mean, we've seen some life come back into the European economy, I think based primarily on this belief that Germany is going, which has room on its balance sheet to, it doesn't have the high debt to GDP levels, it has low borrowing rates, that they can create, fiscally stimulative activity. So I think I don't have a strong view like over the next 12 months of like euro dollar. I would guess it would be euro stronger against the dollar, because I think that's what the U.S. wants, is a weaker dollar. Now, longer term, is there a long-term viable solution for the euro? Might the eurozone eventually collapse or be replaced? I think that's definitely possible. So I haven't given a ton of thought to exactly like the dynamics in the euro currency market. I think broadly speaking, with the dollar, a weaker dollar, lower rates is what the government wants. I think that they will get that. They're starting to get that. I don't think that rates on like a 10-year are going to collapse to 2%. But I do think that, something in the 3s and 4s, low 4s is okay if they're also able to continue to expand, the deficits, which I think they are going to do. So a lot of people, they think the deficits are coming in, that Doge spending is going to save all this money and all this is happening. But that's just not what we're seeing happen. I mean, you look at the most recent monthly Treasury report, we've got a 39% increase year over year of the deficit. We're on pace to do an over $2 trillion deficit. The fiscal spending of the United States, I think, is like a big driver of the economy. It's 25% of GDP. I think if you just yank all that away, I think the long-term solution is to reduce that from 25% to like 15% of the economy. And the reprivatization and what Besson talks about with the reprivatization of the economy, I think that's all part of the longer strategic plan. But again, I think economic realities will preclude them putting in place policies to try to do this overnight. They might put in place policies, but then they're going to have to back away from it. And I think it's not a function of, that they're going to capitulate or they're backing down from the markets as much, or from other foreign leaders, as much as that they're going to have to back away from what the market realities would be if they continue with these policies, and that they're not going to be willing to commit economic suicide. Now, if I'm wrong about that, like I've said, then yeah, we could be heading to S&P 3000 in a depression-like scenario. I just don't think that's where they're going to do. I think at a certain point, Trump's going to say, okay, I don't want to be Herbert Hoover. I need to make some changes. Let's put in long-term incremental ways to fix all these major problems. Let's collect some short-term wins, and let's try to get this economy firing on all cylinders so that the 2026 midterms aren't a complete disaster.
Yeah. If we're kind of starting to wrap up here, what's the maybe last parting thoughts or anything I might have skimmed over that you think is something worth paying attention for investors or any of the listeners that are kind of trying to figure out what's going on over the next, say, 6 to 12 months?
Mm-hmm. Yeah, just, like I said, everybody's personal situation is unique. So I don't really have any specific advice on that front. I think at this point in time, with the markets being as crazy as they are, like, I'm not really doing anything. Like, I mean, I'm kind of in a position right now where I want to wait and see what happens. And, if we start getting down closer to that 4,100 level, then that's where I'll probably be looking to say, okay, let's start putting some cash in. If some good news comes out and it seems like this is resolving quicker, I'll be quick to act at that point as well. But I think, from a long-term perspective, like, I think people need to step back a little bit from the emotion, and they need to look at charts, like look at the 2020 chart and look at some days and weeks where we were just plummeting, and then look at what happened in the second half of the year and how it's just like a straight staircase up. And if you were unable to imagine 3 -5% down days in a row, maybe your emotions are making it impossible for you to imagine 3-5% up weeks in a row. And maybe that is, around the corner. and we're not heading. I would just be cautious that we're heading into like this is it. This is the financial reset, great collapse. Everything is heading to zero. Only thing that's going to survive is gold or something like that. I would caution people from that, because we live in a world where the monetary system is completely determined by policymakers. It's not the 1920s where a physical metal was the basis of the economic system that put certain constraints upon policymakers. There's no reason why the Federal Reserve cannot expand the balance sheet by another $10 trillion. There's like people didn't imagine in 2009 that by 2024 we were going to have a $9 trillion balance sheet. Like before the financial crisis, the Fed's balance sheet was $800 billion. It went up over 10x. If you look at our previous high of 9 trillion, basically a couple years ago, and you go 10x from that, you're at 90 trillion. Most people would say the Federal Reserve could never have a $90 trillion balance sheet. Well, maybe they can. I mean, who's to say they can't? What, like the counterpoint to that would be like, right, inflation, that inflation is gonna do it. I think that a lot of the monetary inflation that was created, in 2023 was oil prices getting jacked up after the Ukraine invasion, combined with the fact that we overdid the stimulus. We pumped it up so much, but in 2009 we probably did a little bit less than we needed, and that's why we had like 1%, inflation for so long. I think there is a level where dollars can be printed, euros can be printed, yuans can be printed, everything can be printed, and I don't think that policymakers want us heading into another depression. And so that's why at the end of the day, I do think like longer term, gold, Bitcoin, and even stocks, because they're priced in nominal terms. I'm not talking about in inflation adjusted terms, but in nominal terms, I think a year from now are going to be looking like they were really, really cheap this spring.
Yeah, I think the message that the sky is not falling, it's not financial Armageddon, and it's all over, I think is a good one to wrap things up on. But I do have to ask my traditional closing question, which is what book should I add to my reading list? Can be finance, history, investments, anything you think would be good.
Lords of Finance, which is just a book about John Maynard Keynes and Strong, who was the Federal Reserve Chair of New York during the Depression, and the leader of the Banque de France and the head of the Reichsbank, Elmer Schock. So it basically goes from like post World War I through to Depression, through the eyes of the leaders of the four major central banks: the Bank of England, the Fed, the Bank of Germany, the Reichsbank at the time, and the Banque de France, the Central Bank of France. And it's a time of a sovereign debt bubble. It's a time where Britain and France were just so underwater, like 200% debt to GDP post World War I. What happened? And I think a lot of the mistakes that were made in the 20s will not be repeated, at this point in time, even though we're facing similar circumstances. Instead of a deflationary crash, the result could be an inflationary bubble, in the coming years. And so that's an interesting one. I also would have to recommend a financial thriller called Quaz, which I wrote, which came out in 2024, that has to do with corrupt central bankers, the blockchain, quantum AI, basically taking over financial markets, essentially a financial collapse, precious metals prices skyrocketing, threats to the dollar reserve status, a lot of stuff that we're seeing talked about today. That's a fictional book, but it has a lot of interesting vignettes and stories about historical corollaries, like FDR's revaluation of gold in 1934 and different things like that. So those are a couple.
Yeah, if my listeners want to go pick up his book, I think that'd be a good place to find your work. But as far as if my listeners want to find you on social media or anywhere else, where can they find you?
At Mel Mattison 1 on Twitter, and melmadison.com is my website.
Awesome. I really appreciate you taking the time. I think you gave the listeners a lot to think about. I think the general overreaction, I guess, is the way I'll put it, as far as what's going on. I think it's probably going to look like a short-term blip in 6 months, 12 months, whatever it is. But I think you definitely gave the listeners a lot to think about. So I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.